Imagine two friends, both 30 years old, living in the same city, with exactly $50,000 ready to invest. One uses that money to buy a rental property. The other puts every dollar into a simple stock market index fund. Then, they make one agreement. They won't compare results again for the next 20 years. Fast forward to age 50, and their financial lives look completely different. One has spent 20 years collecting rent, building equity, paying mortgages, handling repairs, and surviving the occasional empty property. The other has barely touched his investment, simply staying invested through market crashes, recoveries, and moments when almost everyone around him was tempted to sell. So after 20 years, who actually became wealthier? The answer isn't as simple as comparing a house price with a stock portfolio. Once you account for mortgage leverage, rental income, maintenance, taxes, vacancies, compounding, and the time each strategy demanded, the obvious winner becomes much harder to predict. And there's one factor most stocks versus real estate comparisons almost completely ignore. By the end, we'll put both paths side by side and discover not only who ended up with more money, but what actually created that wealth and which path may make more sense for the kind of investor you are. Chapter 1. The big question. Imagine you have $100,000 ready to invest, and your goal is simple. Turn that money into as much wealth as possible over the next 10 years. You now face one of the biggest debates in investing. Should you put that money into the stock market or use it to buy real estate? Let's follow two investors starting with exactly the same amount. Alice puts her $100,000 into a broad stock index fund, giving her exposure to hundreds of companies while requiring almost no day-to-day management. Ben takes a different approach. He uses his $100,000 as a down payment on a rental property and finances the rest with a mortgage. At first, Ben seems to have an obvious advantage. His $100,000 allows him to control a property worth much more than his original investment, while tenants can potentially help pay down the mortgage. Alice simply has $100,000 quietly invested in the market, relying on long-term growth and compounding. But that comparison hides something important. Ben has mortgage interest, property taxes, insurance, maintenance, vacancies, and unexpected repairs. Alice avoids most of those headaches, but she has her own challenge, surviving market crashes without panicking and selling at exactly the wrong moment. So this isn't simply a question of whether stocks outperform property or vice versa. We need to compare leverage, cash flow, compounding, costs, risk, and the time each investment demands. And once we do that, the investment that appears to make the most money may not necessarily be the strategy that truly gives you the better deal. Chapter 2. Alice's stock strategy. Alice takes her $100,000 and chooses the simplest path. She invests it in a low-cost S&P 500 index fund and leaves it alone. No trying to predict the next winning company, no jumping in and out of the market, and no complicated strategy. Her plan depends on something surprisingly difficult for many investors to do. Stay invested long enough for compounding to work. For our example, let's assume Alice earns an average annual return of roughly 10% with dividends reinvested. That doesn't mean her portfolio rises exactly 10% every year. Real markets can fall sharply one year and surge the next. But using a long-term average gives us a simple baseline for comparing her strategy with real estate. After 10 years, something remarkable happens. Her original $100,000 grows to roughly $259,000 before taxes, without Alice contributing another dollar. She didn't manage tenants, negotiate mortgages, replace a roof, or spend weekends dealing with property problems. Her biggest responsibility was psychological, staying calm when the market inevitably fell and resisting the temptation to sell. But that $259,000 figure creates a misleading impression if we stop the calculation there. Alice originally invested $100,000, meaning roughly $159,000 represents investment growth. If she sells everything in a taxable account, taxes may reduce what she actually keeps, depending on her circumstances, holding period, and applicable tax rates. And this is where our comparison gets interesting. Stocks have given Alice something incredibly powerful, passive compounding with very little effort. But Ben is about to use something Alice doesn't have at all: borrowed money to control an asset, worth several times his original investment. That one difference, called leverage, could completely change who wins this 10-year race. Chapter 3. Ben's real estate strategy. Now, let's look at Ben, because this is where the comparison becomes much more interesting. Ben takes the same $100,000, but instead of buying $100,000 worth of investments, he uses it as a 20% down payment on a $500,000 rental property. The remaining $400,000 comes from a mortgage, which gives Ben something Alice never had: leverage. That leverage can be incredibly powerful. If the $500,000 property rises in value, Ben benefits from appreciation on the entire property, not just his original $100,000. If we assume, purely for our example, that the home appreciates by an average of 4% annually, its value would grow to roughly $740,000 after 10 years. But unlike a stock portfolio, appreciation is only one part of Ben's return. The property is also producing rent. Suppose it generates around $30,000 per year in gross rental income. Ben cannot simply pocket that entire amount because real estate comes with expenses, mortgage payments, property taxes, insurance, maintenance, repairs, and periods when the property may sit vacant. If our simplified scenario leaves him with roughly $15,000 per year in net cash flow, that's another potential source of wealth accumulating over time. Meanwhile, something else is happening quietly in the background. Every mortgage payment that reduces principal increases Ben's ownership in the property. After 10 years, if the home is worth around $740,000 and roughly $330,000 remains on the mortgage in our hypothetical example, Ben would have about $410, $000 in property equity before selling costs and taxes. Add accumulated rental cash flow, and suddenly, Ben appears to be crushing Alice. But don't declare a winner yet. Our assumptions are doing enormous amounts of work here. A different mortgage rate, one major repair, months without a tenant, selling costs, taxes, or weaker home price growth could dramatically change Ben's result. We also haven't properly accounted for the value of Ben's time or compared the risks both investors took. So yes, leverage made Ben look much richer on paper. But before we call real estate the obvious winner, we need to make this comparison truly apples to apples, and that's where the numbers become far more surprising. Chapter 4. Comparing the totals. Now let's put Alice and Ben side by side, because at first glance, this comparison looks almost embarrassingly one-sided. In our simplified example, Alice ends the decade with roughly $230,000 after estimated taxes, while Ben appears to have built more than $500,000 in net wealth between property equity and accumulated rental cash flow. If we stop the video right here, the conclusion would seem obvious. Real estate destroyed stocks. But something about that comparison should bother you. Alice invested $100,000 and owned exactly $100,000 worth of stocks on day one. Ben invested the same $100,000, but used a mortgage to control a $500,000 asset. They started with the same cash, but they were never taking the same kind of financial position. Ben had something quietly multiplying his results from the beginning: $400,000 of borrowed money. This is the hidden engine behind Ben's impressive return. When a $500,000 property appreciates by 4%, that represents $20,000 of value growth in the first year, even though Ben originally contributed only $100,000 himself. That is the magic of leverage when things go well. But leverage works in both directions. If property values fall, rental income disappears, or major expenses arrive unexpectedly, Ben's losses can also be magnified, while the mortgage still has to be paid. So what happens if we remove that advantage and compare $100,000 of stocks with $100,000 of real estate purchased without debt? Using our simplified assumptions, a $100,000 property appreciating at 4% annually would grow to roughly $148,000 after 10 years. Add rental income, subtract realistic operating costs and taxes, and the result could look much closer to Alice's portfolio. And under these particular assumptions, stocks could actually finish ahead. Now the story is completely changed. Real estate didn't necessarily beat stocks because houses are inherently better investments. In our original example, leverage played a major role in creating Ben's advantage. But even this comparison still isn't complete. Alice spent almost no time managing her investment, while Ben effectively owned a small business with tenants, repairs, paperwork, and risk. Once we put a value on time, effort, liquidity, and stress, the definition of who actually won becomes much harder than simply comparing two ending balances. Chapter 5. The Hidden Factors: Taxes, Risk, and Liquidity. So far, we've been treating this like a race where the investor with the highest ending balance wins. But real investing doesn't happen inside a spreadsheet. Two investments can produce similar returns on paper while creating completely different experiences in real life. And this is where taxes, risk, liquidity, and unexpected costs begin changing the comparison. Alice has one enormous advantage: flexibility. If she suddenly needs $20,000, she can usually sell part of her stock portfolio without selling everything. Of course, selling investments in a taxable account may trigger capital gains taxes, and selling during a market crash could lock in painful losses. But her money remains relatively liquid, which gives her something valuable that doesn't appear on a performance chart: access. Ben's wealth works differently. He might have hundreds of thousands of dollars in property equity and still not have that money sitting in his bank account. Accessing it may require selling the property or potentially borrowing against it, both of which involve costs: time, qualification requirements, and risk. Selling can also bring transaction costs and possible tax consequences, while rental ownership can bring expenses that no neat 10-year projection can perfectly predict. Then there's uncertainty. Alice could wake up during a major bear market and see her portfolio fall dramatically in a matter of months. Ben may not see a daily price flashing red on a screen, but that doesn't mean his investment is risk-free. A vacant property, non-paying tenant, major roof replacement, insurance increase, or falling local property market can quickly change the economics of his investment. Taxes complicate things even further. Real estate investors may benefit from deductions and depreciation, depending on their circumstances, while stock investors can benefit from favorable long-term capital gains treatment in taxable accounts. But these rules are highly situation-specific, which is exactly why declaring one investment universally more tax-efficient can be misleading. So imagine two lines on a chart. Alice's stock portfolio moves sharply up and down, sometimes testing her nerves before recovering. Ben's property value appears smoother, but underneath that smooth line are mortgages, tenants, maintenance, and concentrated exposure to one property and one local market. And now the question becomes personal. Would you rather own an investment that can fall 30% on a screen but can be sold in seconds, or an asset that feels more stable but may take months and thousands of dollars to exit? Because the best investment isn't determined only by what produces the highest theoretical return. It also depends on which risks you can actually live with when the numbers stop behaving according to plan. Chapter 6. So who actually wins? So after 10 years of stocks, rent checks, mortgages, market swings, repairs, taxes, and compounding, who actually wins? In our original leveraged example, Ben's real estate strategy produced the larger net worth. But saying real estate simply beat stocks would miss the most important lesson in this entire comparison. Because Ben had a powerful advantage working behind the scenes: leverage. Ben used $100,000 to control a $500,000 asset. So when that larger asset appreciated, his gains were amplified relative to the cash he originally invested. Alice never used borrowed money. Her $100,000 remained $100,000 of invested capital and grew through market returns and compounding. When we removed leverage and compared equal amounts of actual assets, stocks performed better under the assumptions we used. But that still doesn't make Alice the universal winner. Stocks gave her simplicity, diversification, liquidity, and almost completely passive compounding. But she had to tolerate market volatility without panicking. Ben gained rental income, mortgage paydown, and leverage depreciation. But those benefits came with debt, concentrated property risk, maintenance, vacancies, and significantly more involvement. And this is where the stocks versus real estate debate usually goes wrong. People ask which asset is better as though there must be one answer for everyone, when they're really comparing two very different wealth-building machines. Stocks primarily reward patience, consistency, and the ability to survive volatility. Real estate can reward smart use of leverage, good property selection, active management, and the willingness to accept responsibilities that don't exist inside an index fund. For many investors, the answer may not even have to be one or the other. Building wealth through diversified stock investments, while eventually owning carefully selected real estate, can create multiple sources of growth and income. Diversification doesn't guarantee better returns or eliminate risk, but it can reduce your dependence on a single path working perfectly. So perhaps Alice versus Ben was never really about discovering which investment always makes you richer. The more useful question is which strategy fits your finances, temperament, time, and tolerance for risk well enough that you can actually stick with it for 20 or 30 years. Because the best investment on paper means very little if you abandon it when things get difficult. So ask yourself, would you rather have the simplicity and compounding of stocks or the cash flow and leverage potential of real estate? If you had $100,000 to invest today, which path would you choose? Let me know in the comments, and if this comparison helped you see the debate differently, like the video and subscribe for more practical breakdowns of how wealth is actually built.